RateScope here. Physical silver demand at SD Bullion has exploded to 2.5 times their previous all-time record. SD Bullion just shattered silver sales records in the aftermath of Friday's historic silver price smash. Friday was unlike anything they've ever seen. The market panic and buying surge on January 30 produced the largest transaction day in SD Bullion history. To put it in perspective, they processed 2.5x more transactions than their previous record, which occurred during the Silicon Valley Bank collapse in 2023. Friday's revenue exceeded what SD Bullion generated in some entire months during 2025. Here's the other side of that story. 1.8 billion ounces of silver were traded on COMEX Friday. Annual mine production is approximately 800 million ounces. More than double global mine production traded in a few hours. Meanwhile, the physical market remains tight, with multiple dealers rationing silver through different mechanisms. Sovereign mints are already struggling to keep up. New sovereign mint orders are now running roughly 8 to 10 weeks out. 30 days ago, delivery lead times were closer to 2 to 3 weeks. I read every comment across our recent discussions. Thank you. It's powerful to see this community using information to make sharper, more decisive moves. The range of your strategies is clear. Some of you are preparing for another leg down, while others are firmly anchored in the long-term macro thesis. That division doesn't signal confusion. It shows a community of prepared individuals, each executing their own plan. That's the core of what we do here. Independent thinking, not herd mentality. We don't sell fear, greed, or Netflix-style hype about instant riches. This isn't a scripted show with a predetermined happy ending. It's real markets and real risk. A necessary reminder for all, especially newcomers. I do not sell signals, coaching, subscriptions, or any insider access. Anyone pretending to offer that in my name is a scam. Block and report them. My only aim is to break down what's happening, free from bias or agenda. For real-time updates, I'm active on X, and for deeper dives, on YouTube. You'll find me only as RateScope on both. That's your guarantee it's me. I am not behind any other accounts, Telegram groups, or private circles. Guard your capital and your information. I will never contact you for money or investments. Let me break down exactly what happened on COMEX Friday. 1.8 billion ounces of silver were traded. That's not a typo. Annual global mine production is approximately 800 million ounces. They traded more than 2 years of global production in a few hours. Here's the smoking gun. After all that massive trading volume, most of those contracts were closed by end of day. They opened positions, smashed the price down, then closed the positions. They weren't buying silver or taking delivery. They were dumping paper to crash the price, then exiting. This is pure paper manipulation. For comparison, normal months. Trading volume approximately 100% of open interest, maybe 120% on volatile days Friday, 345%, more than triple normal activity. And it was concentrated in the March contract, a primary delivery month. They dumped unprecedented paper volume to avoid having to deliver physical silver in March. This implies coordinated efforts by large institutional players to suppress silver prices through massive paper selling. A volume of 317,238 contracts, about 1.586 billion ounces, represents roughly 1.8 to 2 years of global mine production. Dumping that much silver in a single day, especially during a 40% price rout, doesn't look like organic market activity. It looks like deliberate price smashing to trigger stop losses, force liquidations, and crush bullish sentiment. Looking at the numbers, about 75% of you aren't subscribed. If this unfiltered, real-time analysis is cutting through the noise and giving you a clearer edge, hit subscribe. That's how we grow a community built on truth, not hype. If this adds value, drop RateScope in the comments. It helps us see what matters to you and keeps this channel anchored in reality. If it's not for you, no hard feelings. I don't chase empty metrics. I'm here for people who want clarity and substance, not scripted shallow talk. Now, let's connect this to what we discussed all week. Friday, we had the metals crash. Silver down 31%, biggest daily loss on record. I showed you JP Morgan closed 633 silver short contracts at the exact bottom, perfectly timed exit. We discussed Kevin Warsh as Fed chair, anti-QE, rate cuts with balance sheet reduction. Markets sold off on that policy shift away from unlimited liquidity. But here's the deeper truth. Friday's 25 to 40% silver crash wasn't just about Kevin Warsh or dollar strength. That was the catalyst. But the move was also planned manipulation. They used the Warsh announcement as cover to execute the largest paper dump in history, 1.8 billion ounces, 2 years of production. And what happened to physical demand? It exploded. SD Bullion, 2.5x all-time record. Friday's revenue exceeded entire months of 2025. The takeaway is simple. When paper silver collapses, physical buyers rush in. The spot price is primarily a paper price. It doesn't always reflect what's happening in the physical supply chain. Just like banks don't hold cash equal to all deposits, paper markets trade multiples more silver than exists in deliverable form. That's why you can see a scenario where paper silver falls sharply. Physical demand spikes. Physical product becomes scarce. Premiums widen despite lower spot prices. SD Bullion COO Cole Keller recently returned from meetings in Berlin with major sovereign mints. The message across the minting industry is clear. Production capacity is being overwhelmed. Perth Mint has temporarily shut down new sales on key bullion lines just to catch up on existing obligations. Limited blank supply, higher lease rates, holiday slowdowns, and surging demand across the US, Europe, and Asia. As of February 2nd, new sovereign mint orders, now 8 to 10 weeks out versus 2 to 3 weeks just 30 days ago. This gap is expected to worsen as supply pipelines absorb Friday's shockwave. If it isn't already in the pipeline, it likely won't arrive quickly. The market has reacted with fear, selling off gold and silver on the assumption that Warsh will be the new Paul Volcker, pushing rates as high as needed to crush inflation and fully restore dollar confidence. This is a fantasy. When Volcker raised rates to 20% in the early 1980s, U.S. debt to GDP was about 30%. The country could afford it. Today, debt to GDP, 125% and rising exponentially. U.S. is adding $1 trillion in new debt every 90 days. Annual interest on the debt has already surpassed $1 trillion and is on track to become the largest item in the federal budget. The math will make the decisions for Warsh. He can't be Volcker, even if he wants to. The debt load makes that impossible. Here's another massive development nobody is connecting. The U.S. is launching a $12 billion strategic minerals stockpile to counter China. Lithium, nickel, rare earths. Silver isn't mentioned, but make no mistake. Silver is at the center of this story. EVs, solar, electronics, defense, all need silver. There is no energy transition without silver. When governments start hoarding physical materials, it's not because prices are stable. It's because supply risk is real. Paper prices can be managed. Physical availability cannot. Strategic stockpiles mean one thing: just in time is dead. Custody is king. If you don't hold it, you don't own it. Trump also announced a major U.S.-India trade deal after a call with Prime Minister Modi. India stops Russian oil purchases and switches to U.S. plus Venezuela supplies to help end the Ukraine war. U.S. tariffs drop from 25% to 18%. India cuts its tariffs and barriers to zero. India commits to $500 billion in Buy American purchases of U.S. energy, tech, and coal. This is huge for commodities. India absorbed about 25% of global silver production in 2025 with inelastic demand. Now they're committing to $500 billion in U.S. purchases. Where does silver fit into U.S. tech and energy exports? It's embedded in everything: solar panels, electronics, EVs. India's demand isn't going away, it's accelerating. U.S. ISM manufacturing PMI just printed a 40-month high of 52.6 versus 48.5 expected. Above 50 is expansionary, bullish for markets. Manufacturing up, industrial demand for silver rising. Yet silver crashed 40% Friday. Funny how, after a strong ISM, copper and silver went the opposite direction from what common sense would suggest. Again, manipulation, not fundamentals. Current prices as I'm recording: Western spot, $80 Shanghai spot, $100 Western futures, $80 Shanghai futures, $95. That's about a $20 premium on spot and $15 on futures, roughly 26% premium. After a 40% crash, the premium is still over 25%. The physical market is not following paper. What could still go wrong? Bearish case. The bearish case is real. UBS notes silver's 26% drop with intraday swings near 38% is one of the most extreme moves in decades, with volatility near 50-year highs. Natural gas crashed 25% to a 2-week low. Copper tumbled more than 5% amid broad metals selling COMEX raised margins, effective after Feb 2 close. Gold non-heightened, 6%, 8% gold heightened, 6.6%, 8.8%, silver non-heightened, 11%, 15% silver heightened, 12.1%, 16.5% Shanghai. Gold exchange hiked margins from 20% to 26%, more margin hikes, more forced selling risk. At the same time, timelines are filled with Epstein files and war threats, yet no major arrests, no large war has actually started. It feels like a giant distraction from something bigger building beneath the surface. U.S. stock market concentration is at record levels. The S&P 500 Herfindahl-Hirschman Index is around 195, near an all-time high, versus 125 at the peak of the 2000 dot-com bubble. The market has never been this top-heavy. When this breaks, deleveraging could be catastrophic. That's the bearish scenario. More selling, more liquidations, more margin hikes, broad economic stress, everything crashing together. Why the bullish case for physical is overwhelming. Now the bullish side for physical. SD Bullion, 2.5x all-time record in one day. Friday's revenue exceeded entire months of 2025. This isn't speculation. It's verifiable retail demand data. When paper crashed, your 40%, physical demand exploded 250%. Sovereign mints overwhelmed. Perth Mint shutting down new sales delivery times 8-10 weeks, up from 2-3 weeks just 30 days ago. Limited blank supply, higher lease rates, surging global demand. If it's not already in the pipeline, it likely won't arrive quickly. This is the physical bottleneck we've been predicting. Every major gold bull market has had brutal mid-cycle corrections that felt like the end. 1974, gold corrected 47%. Nearly half the value wiped out. Everyone declared gold dead. Then it ran 734% over the next 6 years. Today's 16% pullback in gold is modest by comparison. In a 1970s context, it wouldn't even be a top 5 correction. Structurally, nothing has changed. Tether still buying central banks, still accumulating debt, still expanding silver, still in backwardation. You cannot cure a huge physical shortage by smashing the paper price. The manipulation is not about physical supply and demand, it's about containing systemic risk. Making sense of Friday's rigged session. With volume at 3.45% of closing open interest, March silver saw extreme turnover. Positions opened and closed rapidly, amplifying the drop. After the session, 127 billion ounces worth of contracts were closed, leaving 459 million ounces in open interest. Many traders, institutions exited or rolled positions to avoid March delivery obligations. Speculative short selling dominated. High volume with little net OI increase suggests bullion bank day trading, and algos piling on during the sell-off March is a key delivery month, amplifying the stakes. The sharp OI reduction after the volume spike suggests many contracts were closed to evade delivery, potentially avoiding a squeeze where shorts must source physical silver. However, if standing deliveries remain high despite this, vaults could be strained as soon as March. COMEX registered silver stocks are down to just 104 million ounces. 104 mm ounces registered, 1.58 B ounces dumped Friday. Do the math. If even a small fraction of those contracts demanded delivery, the system breaks. The cartel's efforts to suppress prices in the midst of a historic inventory squeeze risk, igniting a much higher eventual blow-off top in silver. Physical silver demand was already in a 5-year deficit. A 40% sale only increases demand from industrial users and investors. The bullion banks may have bought themselves time, but they are digging their own graves deeper. Where this leaves us. Number 1. 1.8 billion ounces of paper silver dumped Friday. 1,002 years of global production traded in hours. 3.45% turnover in the March contract. 1.127 B ounces closed to avoid delivery. COMEX registered stocks. 104 minus ounces. Paper market dumped unprecedented volume while physical demand exploded. SD Bullion. 2.5x all-time record sovereign mints, 8 to 10 weeks out. This is paper versus physical divergence at an extreme. Number 2, the Warsh. Volcker 2.0 narrative is fantasy. Debt to GDP, 125% versus Volcker's, 30%. US adds 1 T hours in debt every 90 days, interest payments already, 1 T per year. The math makes a true Volcker replay impossible. Meanwhile, US launches a 12B strategic minerals stockpile. Silver not mentioned by name, but central to EVs, solar, electronics, defense governments. Hoarding physical per art supply risk is real. Paper can be managed, physical cannot. Number 3, historical context. 1974, 47% gold correction, then pleasant 734% move, current pullback. There are 16% structural drivers unchanged. Central banks buying debt, expanding tether, accumulating silver in backwardation, 5-year physical deficit. Friday's 40% crash triggered 250% surge in physical demand. When this paper manipulation breaks, the rebound has the potential to be historic. The unresolved tension is this. 1.8 B ounces dumped, physical demand exploded, delivery times tripled, mints shutting down, sales margins hiked again, volatility at 50-year highs, economic stress building. Does the paper manipulation continue squeezing over-leveraged longs? or does the physical shortage finally overwhelm the system? March is a primary delivery month. COMEX has 104 ounces registered. If standing deliveries strain vaults, the squeeze we've been tracking could ignite within weeks. Do your own due diligence. Understand the risks. This volatility is a meat grinder for leveraged traders, but if you understand what's happening, 2 years of production dumped in hours while physical demand hits 2.5x records, then you know this isn't about fundamentals, it's about desperation. They bought time by dumping unprecedented paper volume, but they are digging deeper graves. Physical will win. The only question is when. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly. RateScope out.